a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to talk about some dividend ETFs now that you may want to take a look at in light of the recent Fed meeting with our ETF research director, Nina Mishra, who joins me here. And you've done a little bit of research on this topic. So we're recording this here on the 17th of March. The Fed just concluded their most recent meeting on the 16th of March and really decided to keep rates unchanged, however, kind of left the door open for future rate hikes. In other words, nothing much new.
Exactly. And the tone of the statement was definitely more dovish than expected. And while no one had actually expected a rate hike in this meeting, the probability of rate hikes later this year had really gone up of late because the recent economic data has been better than expected. And after their rate hike in December, the Fed had penciled in 4 rate hikes for this year. But their current projections after yesterday's meeting show only 2 rate hikes.
Okay.
And which the markets liked. Who doesn't like a dovish Fed?
Sure.
Stocks, oil, and gold gained after the meeting, whereas the dollar fell. And the Fed acknowledged that the U.S. economy is improving moderately. The job market is strengthening. Inflation is slowly picking up, but they were more concerned about risks emanating from developments in global financial markets.
Okay, so bottom line for us here in the U.S., rates going to stay lower longer. And what that means for companies that pay dividends is that's good news.
Yes, definitely, because when you can get very low rates from other traditional sources of income, income-oriented investors, they prefer dividend-paying stocks. So we will probably see more investors flocking to dividend-paying companies. And in this environment, dividend-paying companies are going to be, they are going to continue to do well. And then there's a lot of uncertainty in the market because all these developments in the global financial markets. So in the uncertain market environment, these companies tend to do well because in general, dividend-paying companies are high quality companies with solid balance sheets and stable cash flows.
Sure.
And such companies do well when there is a lot of uncertainty in the market.
Okay.
And with improving economy, many companies have been raising their payouts, though many energy companies have been cutting their payouts. And of course, there are activist campaigns always for
Keeps
raising,
it interesting.
Yes, for raising dividends and for raising share buybacks. And in 2015, there were 70 such activist campaigns per FactSet, which is the highest number ever since they started tracking that data.
That's interesting also. So, but the thing is, well, it's good news for the dividend-paying companies. They may get more investors wanting to buy their stock. Still, the fact remains they could cut those dividends at any time.
Yes. So I think when you choose a dividend ETF, you should focus, in the current environment, you should focus on dividend ETFs that do not have a lot of exposure to energy companies.
Okay.
And the 2 we are going to talk about, they have very little or almost no exposure to energy companies. And secondly, I think it is better to focus on ETFs that invest in companies that have been raising their dividends, high quality companies which have a record of raising their dividends over the past many years. So the 2 ETFs that we are going to discuss today
are cheap, ultra cheap,
but
very low. High quality.
Yes, high quality with very low expense ratios that provide exposure to a diversified exposure to these high quality companies.
Okay, and the first one is the Vanguard Dividend Appreciation ETF.
Yeah, the ticker is VIG. I should have put it over there. It holds companies that have been raising their dividends at least for the last 10 years.
Okay.
And this is one of my favorite dividend ETFs. I believe I have talked about it here earlier too. Expense ratio is just 10 basis points, lowest among this asset class. It the yield is not too high at 2.3%, but these are companies which continue to grow their dividends, so that your yield on costs will really grow over months and over years.
Okay.
The current focus is on consumer, industrials, and technology companies. Very little exposure to energy, as I mentioned.
All right, and then there's the iShares Core Dividend Growth ETF.
The ticker is DGRO. This also provides low-cost exposure with expense ratio of just 12 basis points to dividend growth companies. The yield is slightly higher at 2.5%, and sector exposure is almost the same. Consumer staples, industrials, and technology are the top sectors. Both these ETFs are currently ranked number 2 by ETFs by us.
All right, do you own either one?
I don't.
All right, you can check out more ETF information on our website, Zacks.com. If you're not there already, get on over to the homepage, use the Funds tab on the top toolbar, and it will open up another toolbar that you can use to access the ETF section of the website. With Nina, I'm Terry Ruffalo.